Well, good afternoon, Colorado. Chris Lopez here with your monthly market update for what's going on in the world of real estate investment. We're going to talk high-level trends, what we're seeing on the ground, and a couple deals, and we'll go up and down the front range. So I got my usual crew here today, Jenny Bayless with Envision Advisors, talking Southern Colorado. Good afternoon, Jenny.
Hey, guys.
I've got myself here for Denver. Unfortunately, Preston got food poisoning or something, so he is probably at home curled up in the fetal position right now. So, Preston, we missed you. Feel better, buddy. So I'll be filling for the Denver trends and deals. And up north with our new kids on the block for market updates and Envision Advisors expanding is Newt and Steve, who are becoming two regular voices and have some, it's not only trends, but to also have a couple deals to walk us through as well.
Yeah.
Glad to have you back, guys.
Awesome. Yeah. Thanks for having us.
Cool. Thanks.
So as a quick reminder, before we jump into the stats here, we're actually doing a kickoff webinar for Northern Colorado August 1st to kind of give a quick high-level overview for trends, walk through a couple deal analyses, and what the opportunities are that Newt and Steve see in the landscape up there. So check out that, show notes on the link, or reach out. We'll get you hooked up to the webinar or the recording, depending on when you listen to this. All right, so we're going to start down south. Jenny, what is going on down there?
I'll just keep it short and simple, kind of, not much, which I'm kind of glad about because I feel like things have been all over the place the past couple of months. And this one is proving to be kind of slow and steady. So, we went up in median price month over month from May to June by about 2%, which is only down 2% from year over year of June last year, which was the absolute peak, highest median price point that we've ever seen here. So not too bad. I was kind of thinking it would be a little bit more of a bloodbath, but 2% is, kind of a blip. Average sales price is actually up year over year. And then I think something that's interesting is that condos and townhomes, they're actually up year over year for median sales price as well by 2%. So I just thought that was kind of, an interesting factoid right there. Just in terms of what our clients doing down here, kind of just more of the same. We have Leah just closed a house hacker, a room by room house hacker. She just got a room by room non-house hack under contract.
Give us the rough, what are the rough price points and numbers like on the room by room house hack and the room by room rental?
Yeah. So the room by room house hack, I think was in the mid threes. I don't actually know. I was kind of removed from that transaction, but we are recording a podcast on it tomorrow. So stay tuned on that. The non-house hack room by room was in the mid 400s. I'm super excited to see what he's doing on this property because he sent me a video and basically is adding bedrooms everywhere, all over the house. So that should be kind of exciting. It was like a 2006 build, I want to say. So it's going to be really good. I think he's projecting about 10% cash on cash. So it's pretty good. So he's going to be doing that. And then just a traditional fourplex long-term rental as well. So yeah, just kind of like very typical transactions is kind of what, we're seeing right now.
Yeah. So kind of just business as usual and,
yeah,
certain deals still make sense, right?
Yep. And then I know we were chatting earlier, for those of us that have, been with the channel for a couple of years. I know we did a property that I had renovated a couple of years ago. Those tenants, they moved out of state. Got it turned around in less than 24 hours to a new tenant for like $200 more than what I rented it 2 years ago. So I was kind of surprised at how quickly that went, given that we're kind of like late in the summer now. But single family homes, they are, very much in demand down here. So just kind of, keep that in mind as well.
So high level, no dramatic price swings or changes. House hacks, room by rooms, multi deals in the pipeline, and rents are still staying strong.
Yeah. Yep. So just kind of status quo, which is good, I think.
I want to dig in the fourplex for a second here, because I was actually texting with the investor down there too about it. What are you kind of seeing as far as like just the play there, the cap rate, and just the overall, like, that the 2, 3, 4 unit mix? How are those numbers panning out now versus like a year ago in general?
Yeah. So really, the prices haven't really changed that much. Which is interesting because fourplexes are in that weird dichotomy where you can get the residential loan, but you're still kind of, you can't evaluate it based off of the performance of the property. So it's kind of in that little like strange spot. But this investor his bread and butter has become fourplexes. Like he treats them like his babies. Like he cleans them up real nice, takes very good care of them. This one might need a little TLC on it, but if anyone, he's the right person for the job to take care of that. So in terms of performance, he's kind of all over the place with his financing and everything. We'll have to have him back on. But yeah, he has a couple that are paid off. He has some that are leveraged. I believe he's putting 25% down on this one. So yeah, we'll have to have him on and just kind of give us like a composite of his whole portfolio. But
cool, because this one there's some value add to it, right?
Yeah, absolutely. There's 2 units that are rented right now at, I want to say, $1,250 and $1,300 plus rubs. And then there's 2 that are vacant. So which are really good rental rates for fourplexes in Colorado Springs, given that they're just, basic 2-1s. So yeah, I think he's pretty attracted to the rent rate on that. And he's very good at tenant management and, finding great people to fill his properties. So I think he'll be successful in this one.
Fantastic. Well, great update, Jenny. And of course, if listeners out there want more details, reach out to Jenny, or make sure you also plug into the Colorado Springs Real Estate Investing Podcast. Jenny and Leah do a lot of, hyper local data and also deal analyses. So a couple of those will be coming up in episodes in the near future. All right. So moving up to Denver here, no real changes, kind of like what Jenny was saying. Inventory is about the same where it was June of last year. It's up slightly from last month, kind of within seasonal norms. But in terms of general activity, all about the same. Price point has stayed relatively flat and nothing too exciting there. Like year over year, it's down 0.3% for average price. So it's flat. Now, last month to this month, or May to June of this year, up about 2.5%. So I think that kind of goes with the indicators of, hey, we kind of probably hit the worst part, flat, and maybe trending upwards is my best guess, and what a lot of the data is pointing towards. Beyond that, no real updates and trends. Couple things I'll mention on here is right now homes are selling about at asking price. A lot less like crazy bidding activity. And homes that need work, like the TLC homes, they are sitting on the market longer. So if you are selling a property, people are definitely taking fixed up products, which makes sense if people having to put more down or have a higher interest rate. They don't have to buy a property, then sink $20,000, $30,000. We're talking especially for the average investor, average owner out there. So that's kind of like the one trend we are seeing, which is no surprise. And then moving up north, go up to northern Colorado, and Steve and Newt, they are apparently trying to outshine me and Jenny as the new kids on the podcast block here. They actually prepared like slides. So Steve's gonna walk us through actually a new construction deal up there. We've talked about new construction and definitely lots of opportunities up there in northern Colorado. So walk us through that. We'll do a good job describing it, but if you can't watch the video, just check the link in the show notes and we'll link it to all the notes that Steve has in there. So Steve and Newt, you gotta tell me when to press the arrow keys for you, man.
Okay, well, let's Newt and I'll walk you through, but there was one that we wanted to kind of talk about, and we were seeing some new construction, and when these there's basically two kinds of sellers that are kind of hitting the market right now. Those that have a reason that they have to move, or kind of change where they're at, and then new construction. They have different construction loans, and some of these builders are trying to keep their teams in place, so they want to keep them working, and they're working kind of like Jenny said, it's kind of slow and steady. So they're moving at a slightly slower rate, but they still have periodic deals that pop up. And so for those of you that are not familiar with Property Llama and what Chris has been talking about it on some of his podcasts, Property Llama is a great tool that allows people to, financial investors, real estate investors, to be able to kind of look at their portfolios and then optimize those. What it also does, it has cool features that allow you to do market underwriting. So you can do a deal analysis with them. So I am, kind of still a strong proponent of some of these new builds because that's what I invest my money in. And so there's one model in particular that I'll go to the next page. So they are offering $50,000 off for a perfectly fine location. And it's also with 3% seller concessions. So you can get in for about $63,000 worth of equity when you buy it day one. So this is some of the underwriting that's available at a 7% interest rate. This is kind of what it looks like. So you can go in, put 25% down, buy the property for $439. The actual value is going to be $502. So you're buying $63,000 worth of equity day one. So if Chris, you'd go to the next one. So what Property Llama also is able to do is it kind of puts in all of your variables. So you get your NOI, and NOI, as we talk about, is agnostic to the loan. It's just what the income will do relative to the property. And so that's how we do cap rates in that too. So it does show a negative cap rate, but if you can save $15,000 going in and buy $63,000 worth of equity, you can do that for a year or two and have that be negative, and then refinance it at some point.
You mean, I'm gonna jump. You mean negative cash? I think you said negative cap rate, and I know we're looking at cash flow.
I'm sorry, negative cash flow. If I said that incorrectly.
Yeah. So for those who aren't watching, with the $50K discount seller concession property, about a negative $300 a month with full underwriting and property management and reserves, compared to about negative $650 a month. For full price. So about $300 difference plus that equity bump.
So it ends up being, if you go to the next slide, it's about $4,000 a year that it ends up costing. And so you're still having about that in debt pay down, and you still have the 63,000 and you paid 15,000 less going in. So, you can afford it for a couple of years to be able to earn the appreciation and, have the debt pay down as well. And then refinance it at, call it 5%, and kind of get a feel for that. So this is what's really fun about Property Llama, is it allows you to kind of run these different scenarios. So go ahead and go to the next one. So if you were to buy that same property today, that you walk in and buy at a $63,000 premium with equity, when you refinance it with those same numbers, the same NOI, it would be roughly about $100 a month in positive cash flow. Plus you're getting, the appreciation and debt pay down in a new community. It also has less property maintenance. So I kind of factored that in because they're brand new homes. And in the first year, you have a warranty, and then years after, you shouldn't have to worry about roofs or, water heaters or other stuff. So that's kind of, how that would look. And when we look at the cap rates, if you go back just for a second there, that cap rate is based on the 502 value. So it's just over a 5 cap rate if you use the price that you purchased it for. So, that's kind of nice to have a new house, 5% cap rate, and it's able to cash flow with all of the expenses put into it, upfront. So, and then if you look at the last slide on that, there's, kind of your equity that you can start to build quickly. So, you start out putting $119,000 into a property like that, but you immediately have $173,000 worth of equity. Then in 5 years at 4% appreciation, you'd be at $300,000 with the equity and the debt pay down. So there's still deals like this out there. I called the builder yesterday, and it's still out there. So it's available, and we're going to put it on a deal blast and get it out there because, this kind of thing doesn't come along very often. And so just to give you some perspective, this is the same model that we put my son in. And he just moved out, and we actually got $200 more in rent a month than I was using in the deal analysis when I bought the property.
Great. So, I mean, this is like one of like the, opportunities in new construction in general, especially up in Northern Colorado. You guys have a lot of space to build out there. But, for this, while, rentals, unless you do more creative stuff like Airbnb, not amazing cash flow, but hey, buy a place with some, walk into equity, turnkey should be very, very low maintenance for a number of years. And then you're going to play the refinance game. So for like a turnkey kind of easy button, hands off, like these investments make a ton of sense in the grand scheme of things. Of course, underwrite that, hey, for a little bit, you'll be subsidizing the property a little bit, or simply put more money down. But in terms of like just an easy button play, low headache, I like these a lot.
Yeah, this is Steve's, his go-to strategy.
Yeah.
The new construction.
Yeah.
We bought this model for $492 last year, and that's what we house hacked with our son.
So you bought for $492 last year, and then they're able to get it for what you said, $460 now with a discount.
So today you could buy this with the options, generally the package that comes in it that we use for kind of the landlords. It's like air conditioning, fence, landscaping, and stainless steel upgrades. And so it'd probably rent for somewhere around $2,700 a month. And so that's a pretty good, and that's without pet rent or others. And so you've got a pretty good brand new place that's, going to hold up for years.
Awesome. And then I know Newt,
I think Jenny had something.
Oh, I'm sorry. Go ahead, Jenny.
Yeah, I had a question. Since there's a lot of new builds up there, are you guys seeing most of them be within metro districts, or
Yes.
or how is that working out?
Yeah, metro districts are kind of the way of the law, the way of the land up here. They seem to be somewhat divisive. You either love them or hate them, or maybe you hate them or you tolerate them. And I kind of understand them because I have metro in most of the places we have properties, and so what I appreciate about them is it's replacing that second HOA in a lot of ways. So if there's something wrong with one of the sidewalks, they come in and replace it. In the community that I live in, there's this magnificent pool, and kind of, they call it it's a water park. There's golf courses and things like that are funded through it. So there's a lot of amenities, and then you can go pick fruit in the neighborhood. So there's a lot of things that goes towards. Now it does cost, but it also shows faster appreciation than some of these other areas that don't. So it'd be great to see a comparison, because metro districts, I think, can be good if you have a skilled, I guess, land developer that puts those metro districts in place. If you have the one that's always been the kind of the signal for bad doing it poorly is like down in Johnstown. I think it was Thompson River Ranch or something like that. So they got really upside down. And so now that's what everybody holds up when they say, oh, metro districts are bad. Look at that one. But, I think Windsor up here and Weld has more of them than most communities. Larimer and Loveland, the mayor there is against them. And so they fight them tooth and nail. On our side in Weld, there's a lot more of them, but, you can go see tractor pools, and, there's a snow hill and a beach and all kinds of amenities that they tend to bring in. So to me, I think about it as like a second HOA that provides a lot of value in a lot of cases.
You can often write off the tax deduction anyway.
Yep. As an investor, yes, that's,
Yeah. And I think, like you said, so good, Steve, they're not, good or evil.
just
but
are.
they are there, and that's how the infrastructure is expanding. And as you're looking at a deal in metro tax districts, just make sure you understand that, and do your due diligence on the district as well, because there's always some, like the one you mentioned, that are that aren't good or don't perform well. And there's others like Highlands Ranch, which is, a very successful one from what started 40 or 50 years ago, which is one I live in. So they're all across the board. So it is what it is. Make sure you understand it and do due diligence.
Yeah, I know. I think I don't remember exactly, but the legislature just put some new oversight in over metro districts in the last legislative session. So there'll be a little bit more accountability, because there is some degree of concern out there that, they can kind of do whatever they want. They can raise their mills rate. They can do whatever they want to certain levels. So they now have some more accountability. So I'll be interested to see kind of how that plays out, because what happens is the developer goes in, they basically run the metro district because there's no houses there. And so over time, they're supposed to transition that over to, kind of the community. But, there's some legislation that'll be kind of developing to be able to show, how that can be a little more accountable. Regulated. I always hate saying regulated because I don't like regulations, but at times they have a good balance.
Cool. And then I know, Newt, before we hit record, you had started talking about a fourplex.
Yeah.
And going to do some quick stuff to kind of like, hey, here's some fourplex. I think it's a fourplex in Greeley, you said?
Yeah, this one.
Yeah, so give us the rundown on that.
Yeah, basically it's, it'd be it's an older fourplex that would be a great investment for some parents wanted to have an investment for their child that's going to UNC.
Yep.
And that would be a perfect fit because it's actually under 500. You could probably get it for under 500. It's been on the market a while. Being that it's older, it may have some issues that you need to address, but after that, it's cash flowing at 5% with 35% down. So, your cap rate's a little around 7%, and it seems like we're seeing more. I was just telling Steve, I've actually seen quite a bit of multifamily stuff coming up in Longmont, Loveland, Fort Collins, Greeley. I mean, it's all over the place. And if the numbers pencil out, there's some deals to be had.
Do you know, are you starting to see like cap rates trend up or drift upwards yet?
Not yet.
Okay.
But it does seem that a lot of the numbers have been, I've just flat, if effectively for the cap rates, or maybe a little negative sometimes with the current list prices. But as sellers decide that they're ready to get it off the market quicker, then those things will change.
Awesome.
Well, and it seems like, if rents are appreciating, NOI is going up. And then, if the prices are roughly flat to slightly up, then, those, cap rates are going to increase a little bit. It's when, kind of rents are a little bit down and appreciation's going like crazy that the cap rates get really compressed. So, the one thing when we were talking about the metro taxes, Jenny, what do you guys see down in Southern Colorado? Is that pretty, pretty much the way it works down there in kind of all the new construction, or is it different?
Yeah, at least in Colorado Springs, Monument area, that's definitely the case, is that there's metro districts. Some of the stuff out east of the Springs. And then we have noticed that more of the like in-town developments, I would say. I don't know how else you'd describe them, like the stuff that's already like surrounded by existing neighborhoods and whatnot. Those are usually not on a metro. Obviously, you need to do your own due diligence for each instance, but that's kind of the trends that we've been seeing.
Yeah, we're good. Thanks.
And then we got Steve put together a little bit more data, and this is not necessarily Colorado specific, but more just some macro trend stuff for historical data. So Steve will walk us through this again. We'll talk about the graphs, but of course we'll put these in the show notes as well.
We're having a lot of conversation around kind of affordability in that. And so, when we look historically, it's good to kind of get some perspective, but, there's a lot of conversations around, boomers killed everything. Well, the boomers, were in 81 actually paying 51% of their household income towards housing. And so now we're at like 30, 34, 36% today. So, while it seems, challenging, that it has been worse over time. And so that's what is kind of like, being, in today's dollars demonstrated. So, and if you look at the next couple slides, there's an inverse relationship to the increase in mortgage rates and the prices on housing. And so this was back in the 80s. So when interest rates went way up, it really put a damper on the housing prices. But then you see after that, interest rates started coming down, and you can see that housing prices continue to go back to appreciating. So it makes perfect sense, but sometimes we're in the middle of it. We don't always see it. So it's good to look historically. So, things started to rise back up after that point. And if you go to the next slide, it just kind of shows more of the same. So, interest rates were in that 6 and plus, and it was dampening down the housing prices during, and up to the kind of Great Recession in 2009. Then after that, they had, which housing caused because they were giving away houses with, just a signature. And so after that kind of got cleared out, investors really started coming in. And so the interest rates got dropped back down. That spurred housing appreciation. We all saw that going, gosh, wish we would have bought them all there in 2009, but we didn't see that coming. So then you fast forward to the last 5 years, and that's the next slide. We saw that again. So in 2000, during COVID, all of a sudden people wanted to move out and iBuyers started coming in. So they drove up appreciation really significantly. And it wasn't helped because we were printing money, buying mortgage-backed securities, and the interest rates dropped really low. And so that really just accelerated things to a point where they've gotten to today, where they're trying to get the housing price as a portion of the CPI down to a reasonable rate. So once they do, then we'll probably see a more even rate. But I think the last CPI number, 70% of that was on rents, which they have the algorithm for housing, and then they have rents. So, we're going to see this for a little bit longer till they say, okay, we've seen enough, and then things should start getting back to normal. But that's when people will come back in the market. Interest rates will be better. Appreciation will kind of re-kick in, but it's not today. But people that are savvy buy equity today, refinance for cash flow tomorrow.
I mean, great update or, analysis on there. And yeah, I mean, that all makes sense. And, I'm looking at this last chart here with the prices. Do you think you got the red arrow pointing pretty straight down? Do you think there'll be a significant price drop, or are you more just saying prices will be flat for a bit?
That's just meant to represent pressure. So it's just downward pressure. It's not that the next one's going to be some sort of collapse. I don't believe that at all. There's too much in terms of how credit is delivered to people that have to be able to justify that. So they're not handing out stuff like they did back in 2007, where people were getting 125% of price.
Cool. Yeah. I mean, I think, where we see that flat in the prices, I think that's kind of where we're at. And we'll start seeing appreciation tick back up here again in the near future, modestly, and maybe flat for a bit. But that's my prediction. So people on YouTube can roast me in the comments and say how price is going to crash instead. I don't agree with you, YouTube comments. I think prices will be choppy and then go up again.
I agree. You
agree with me or YouTube?
I agree
comments?
with you.
All right.
Just because the inventory is still very low. And I mean, we're going to be growing up in northern Colorado, but
you guys have all the population growth apparently now.
Yeah, about half of it anyway. Wow. And, basically I think that this is a great time for buyers that are prepared, because the prices being where they are, that's going to be a good time for us to go ahead and get something, in their portfolio for them. Because when those interest rates, if they do make a tick down, that's when the prices are going to come back out. Because Steve and I have talked about this in length, that, that buyer pool is just going to flood back in the market once it's regulated the interest rates down to a level where they feel like that's the low rate now,
Yep.
it's definitely going to matter. So if you can get into the real estate game now, this is a good time to do it.
Yeah. And, because of the way the situation is right now, people that are in that, I don't know if it's that second quartile or, that bottom third of potential property buyers can't get in. So what are they doing? They have to rent. And so when there's a limited supply of rentals, rent goes up. So, we just turned a property over in West Greeley, and, I was like, okay, we were able to rent it for $275 more a month. So apartments and townhouses sometimes compete with each other. So, they're, at 2 or 3%, but single family homes up here are probably in the neighborhood of 6% rent appreciation. So, because that one that we just turned, that's a 14% rent increase to be able to get it up to what market rates are now. So, that feels good. That's $3,700 more cash flow in this upcoming year.
Awesome. Well, guys, this has been another great podcast. Anyone out there listening have questions, reach out to us. We all know the market. We're happy to sit down and chat with you more details or pass along resources to you. So want to say thank you, Jenny. Thank you, Steve. Thank you, Newt. Another awesome podcast.
Thank you, Chris.
We'll see everyone next month, and we'll hopefully have Preston back with us as well. Bye, everyone.